What is up, guys? This is Matt Cox back with another episode of the Saucetown Investor Podcast, recording from my beautiful library here in downtown Manhattan. Just kidding. I don't have that. That would house with that here would cost probably $10 million. So I am on for the first time on video. So bear with me here. But it is Monday morning here in Manhattan following the Super Bowl. For those that watched, the Eagles absolutely beat the living hell out of the defending champs, the Chiefs, who were going for the three-peat. And so there were some interesting observations from the game that I think can actually apply to the investing world, both in real estate or stocks or whatever you guys do with your money. But so coming into the game, the Eagles have star running back. His name is Saquon Barkley. He's arguably, I wouldn't even say arguably, he is the best running back in the NFL. Coming off, some would say maybe the greatest running back season in NFL history. I know some people will push back on that. Point is, it's up there. This guy's the Eagles' best player. He rushed for over 2,000 yards in the regular season, which is, there's only a handful of guys in the history of the NFL that have done that. Following that huge regular season, in the playoffs, he rushed in each of the 3 rounds. He rushed for 119 yards in the first round against my beloved Packers, who actually gave the Eagles maybe the best game of any of their opponents. So we're just gonna say the Packers are the runners-up this year, not the Chiefs. In the second round, he rushed for 205 yards against the Rams. And then in the NFC title game, he rushed for 118 yards on the Washington Commanders. In those last 2 games, he averaged 8 yards per carry, which for my non-football fans, that's insane. I mean, a really good running back might average 5 yards a carry, and that is like really up there. I mean, he was breaking, for those that watch, 60-yard runs routinely. So coming into the Super Bowl, right, this guy is, he's without a doubt, he is the Eagles' best player and their best offensive weapon. And so the Eagles win the Super Bowl, absolutely crush the Chiefs 40-22. Game wasn't even that close. The Chiefs got a couple late touchdowns. I think the score was 40-6 at one point. It just an absolute beatdown. So your assumption in this would be Saquon must have had a massive game, right? He's the star player. His team scores 40 points, wins the Super Bowl. Guess what Saquon's rushing numbers in this game were? He had 25 carries for 57 yards. That's 2.3 yards per carry. For those that know football, that's a terrible play. If you gain 2 yards every play, you are not going to win a lot of football games. So, this morning, Monday after the Super Bowl, listening to a lot of sports podcasts and talk shows and things like that, the big takeaway from a lot of people is, man, if you were the Chiefs entering the Super Bowl and you told me we're going to hold Saquon Barkley, the best running back in the NFL, to 2 yards a carry, we're going to beat the shit out of the Eagles. This guy is their biggest weapon. We stop him, we're winning the Super Bowl. And what actually happened? They lose the game 40-22. The point here is it's very easy to look at one data point like that if we stop their best player, we're going to win the game. But when you talk about, economists and stuff will call it second level thinking, you think, why did Saquon Barkley average 2 yards per carry? The reason Saquon averaged 2 yards per carry is because the entire Chiefs defense was focused on stopping Saquon Barkley. Everyone was up near the line of scrimmage. They said, hey, we're not going to let Saquon beat us. And guess what happened? Jalen Hurts, the quarterback for the Eagles, who'd had kind of an up and down season, had an incredible game. I mean, he hit a deep ball in the third quarter I think that was to Devontae Smith. That was kind of the dagger. It was an absolute perfect throw. But I mean, he threw one interception, but aside from that, he played a spectacular game. And so in many ways, he didn't have a great game, or Jalen Hurts did not have a great game despite Saquon having a bad game. He kind of had a great game because Saquon had a bad game. The Chiefs sold out to stop Saquon, and that's what opened things up for Jalen Hurts. So in the world of investing, you'll hear some really smart people in the econ space or the investing space say things like, you could tell me what the headlines of the newspaper are going to say a year from now, and I still wouldn't know how to invest my money. It takes a degree of humility to say something like that. I mean, here are some examples. So in 2020, as all of you know, we had a global pandemic. Okay. So take yourself back to, December of 2019, and you have a crystal ball, or maybe you know somebody in China at the lab or the market or wherever you think we're not here on this show to talk about your COVID theories, but say you 100% know there is a pandemic coming and the entire world is going to shut down for multiple months. People are going to lose their jobs, et cetera, et cetera. How would you have invested your money? You probably would have said the stock market is going to absolutely collapse, Armageddon, right? I'm going to get my money out as quick as I can. Here's what the stock market actually did in 2020. Okay, there was an initial drop when the pandemic hit. The market finished the year up 16.26%. For historical context, the market averages about 9 to 10% a year. Then in 2021, the following year, you would think, we're still in the pandemic, we're still seeing the effects of it. The world shut down for a bit. The market went up almost 27%, which is an ungodly year. Those are incredible returns. So if you had seen these headlines and just pulled your money and sat it out because, oh man, there's a pandemic coming, I'm going to cash. Let's conserve here. Let's get our money out of harm's way. You would have missed out on 2 years of incredible returns. So again, much like Saquon in the Saquon and Jalen Hurts in the Super Bowl, in many ways, these market returns didn't happen despite a pandemic. In some ways, they happened because there was a pandemic. Okay. And what do I mean by that? Well, when the pandemic hit, if your assumption was, okay, no one's going to, the government's not going to do anything, then yeah, the market probably would have crashed. But what happens when a crisis hits? The market in this case, the government in this case, printed $1 bajillion. They moved interest rates to zero. They did everything they could to prop up the stock market and asset prices. And none of that stuff happens if there isn't a pandemic. We just keep humming along. Maybe who knows what happens in 2020? Maybe we have an average year and return, 10%. Maybe we have a down year. Who knows? But because this pandemic happened, we printed all this money and the stock market ripped for the next 2 years. So we talked about interest. Speaking of interest rates there, a little bit more specific to the real estate world. So if you remember back to 2020 and 2021, we were getting mortgage rates, in some cases as low as in the twos, like the high twos, 2.75. I saw some people down as low as 2.5%. These low rates continued into early 2022, because the government wanted to keep rates low and support the economy throughout the pandemic. So now take yourself back to early 2022, and rates are still at, let's just say they're at 3%. I don't have the exact numbers. Again, you go to your crystal ball and it tells you, hey, 12 to 16 months from now, mortgage rates are going to have jumped from 3% to 8%. Okay. If you had that information, what would you have done with your real estate? What would you have thought was going to happen? Your instinct would be that, A, that's ridiculous. That's never going to happen. And B, if it did happen, that's going to absolutely crush the housing market. Home values are going to plummet. And what actually happened is none of that occurred. Home prices dipped very marginally when rates first started going up, but then they started going back up again. Not crazy amounts like they were in 2020 and 2021, but rates went from 3% to 8%, and housing values went up. So again, second level thinking. Okay, if the if the Fed is continuing to raise rates, what does that mean? Well, it probably means the economy is in pretty good shape, right? Like we talked about with COVID. If they're dropping rates, that generally means something bad is happening. In 2020, that was a global pandemic. Other cases, it's been a financial crisis, whatever it may be. But if they're dropping rates, there's a reason for it. And if they continue raising rates, there's also a reason for that. The economy was growing, people had jobs, everything was good, except for there was inflation. So they had to raise rates to tame inflation. So on the flip side of that, we're sitting here in early 2025. If somebody tells you that, rates are going to be back to 3% in a year, your immediate first level reaction is that, okay, well, housing prices are going to rip, the stock market's going to rip, everything's, just going to be booming, right? The next level thinking is, okay, but if rates are being lowered to 3% or if mortgage rates are at 3%, why? Like what caused that to happen? And odds are, I don't think it's going to happen, but if rates go back, if rates are at 3% a year from now, that means something really bad happened. They don't just do that because they think it's fun and they feel like it. So if rates are at that level, it means there's been some sort of probably a crisis in the economy. So just some thoughts reacting this Monday morning, listening to people talk about the Super Bowl and Saquon's performance and the Eagles absolutely rolling the Chiefs despite their best player having a poor game. The same stuff applies to economics. I mean, somebody can tell you the headlines and you're still not going to know what is going to happen. So, I mean, that's a long way of saying, guys, whoever tells you they know exactly what's going to happen is kind of full of shit. So if you're in real estate, that means just buy good deals today. Don't try to predict what's going to happen 2 years, 1 year, 3 years from now. Stock market, same thing. Put your money in and let time work, let compound interest work, because trying to predict the future it's hard enough without the headlines. But even if I told you the headlines, you can't predict the future. So, guys, thanks for joining today. First time on video. If you enjoyed this, please subscribe. You can also follow me on my blog. That is mattcox444.substack.com.